Even as headlines fade, private markets remain top of mind for investors. The latest CIO Private Markets Quarterly addresses the most important conversations around private credit growth, performance of private equity versus public markets, and record-breaking infrastructure fundraising. Today, we're going to break down all of that data and more, and what it means for your portfolio, right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us here in the studio. Obviously, private markets have been really top of mind. The headlines, obviously, as many of you probably are aware, especially earlier this year and late last year, really kind of raised some alarm bells. And so I've amassed a great panel of CIO experts to talk us through UBS's thoughts on the private market space. So let me start with you, Leslie Falconio. Thanks for being here. In the recent quarterly publication, you are discussing normalization within private credit versus pockets of vulnerability. And maybe you can elaborate on that a little bit, because I want to break down sort of, the complications of this topic for our viewers. And here's the other thing, is do you believe that the negative headlines have overly influenced performance, especially that we've seen over the past several months?
Yeah, I mean, that's, when we came into this year in 2026, I think one of the major points that we were trying to drive home with our investors is to lower your expectations of return. Okay, that's both in the public and private market. We came into 2026, spreads were very, very tight. And most of the value add or total return would actually happen through like manager dispersion, right? The differentiation of managers, differentiation of manager total return, we felt would be the driver. Now, when you talk about negative headlines, right, and negative headline risk, when you have this sort of snowball start going down the hill and building momentum, and negative sentiment becomes so widespread, even funds that really shouldn't be hit start to get hit. So right now, I think going forward in particular, you're going to see even greater dispersion between manager total return. But the negative headlines have really been a big part as to why we've had such headwinds in terms of some of the things within private credit. Now, I'm not trying to downplay some of the risk and potential that we might see. And as you read in the report, there's no question during that 21-20 type of era when we had, this post-COVID, when Fed funds rates were very, very low and a lot of money was coming into, the private credit was starting to really kick in on a growth spectrum, particularly since during that time you weren't getting a lot in the public credit, the public side, that a lot of these loans were mostly technology, mostly software, and some of them were, as I would say, I don't want to say it's a survival bias, but a lot of them are facing risks today simply because of a lot of this AI disruption has happened faster than what people had thought. Now, that doesn't mean that every software loan is going to have a problem, but it just means that the shift that we've seen in terms of, AI disintermediation, the Fed funds rate, moving higher, which has caused some, headwinds in terms of things like interest coverage, and also large growth in private credit, which have gone up maybe about 15%, over the past 5 years, which is a really strong growth rate, granted from a fairly low base, but still very strong in terms of percentage change. You're going to have these sort of, we call these pockets of vulnerability, but there's a difference between, systematic stress and sector-specific pressure. And that is, I think, one of the things that we're trying to convey. And unfortunately, one of the, results of such negative sentiment is the market doesn't differentiate. Okay, it just takes that negativity and it kind of spills through. Now, we know that there are different funds who have different concentration risks. There are different funds that would go into what we call during that 21-year time, those annual recurring revenue loans or ARR loans, which really are based most on, future cash flows than say EBITDA growth, right? And those kinds of loans are the ones that are facing certain problems as we have this AI disruption being pulled forward so much quicker than what people anticipated. Now, every business model is different. We really don't know what the results are going to be in terms of, AI, in terms of the survival, those who adapt. But in terms of our recommendation, what we've always recommended are those that are higher EBITDA loans, higher growth, obviously diversification, and we've stayed on the sort of top spectrum of that lending market. Now, which brings me to the second point, or the third, which is very important as well. Everyone thinks private credit is just direct lending, and it's not. So if you have a $3.5 trillion around private credit market, maybe like a 1.2, 1.4 is in the direct lending space. There's many more sectors that we're going to talk about today that are beyond just that direct lending space. So I do think that the negative headlines have really played into some of this underperformance more aggressively than would have occurred. But with that said, we can't emphasize this enough, and we try to do this heading into 2026. You really need to mitigate your expectation of returns. That 11%, that 12% that you saw 2.5 years ago is not the market today, right? And with all the negative headlines that we've seen, we're not seeing necessarily this big blowout in terms of where these private credit spreads are, and we're definitely not seeing it on the public side either. So spreads are still fairly compressed, right? But one of the things that we look for in how we structure the portfolio in terms of diversification and not having concentration risk, is that we look for those things that have low non-accruals. Now, everyone's coming from a very low base in terms of the non-accrual side, right? They just haven't been very high, and returns historically have been much better in private credit than the public. Now, that's backward looking, but still we think that manager selection going forward will actually, those that have done the due diligence, don't have a concentration risk, are really going to be the winners. The last thing that I do want to say, which is very important, everyone talks about redemptions. Like, redemptions are the new sort of, they used to talk about pay in kind. It's really about redemptions now, right? And I can't emphasize enough, and there was a BIS report that came out that looked at how much retail is really owned by in private credit, and it's like 10 to 15%. It's the retail side that's selling. Right? It's the retail. It's not insurance companies or endowments or institutional funds. It really has been that retail side. And we can't stress enough that when you look at these funds, whether they label it semi-liquid or whatever nomenclature that is put on, these are long-term holds, right? They're not meant to be traded versus public. These are longer-term holds, and you just simply compound that income over a long period of time. But the expectation that you're going to get in and out of these types of funds is really not what these structures are about. And if that's the case, that you want that, then this probably wouldn't be the type of investment that you want to do. But again, for those that want to have diversification in alts to get that compounding income, then we think private credit will do just fine. We think it's a little bit overdone in terms of negativity, particularly with the headlines. But again, staying with higher quality and diversification is going to be key.
Great. Thank you, Leslie. Great way to get us started. And clearly there's, been a lot of headlines in the private credit space. So, Jennifer, I want to kind of move over a little bit because, when we look at private equity, there's been a lot of, obviously this year has been volatile. We know that there's a lot going on with geopolitical conflict, the Iran war, et cetera, and, all the AI talk, software, et cetera. So in some aspects, public markets have outperformed privates so far this year. Is this still the time that you're recommending investors look, and obviously being selective, at the private side of the market? Because that's really probably a question that you're getting a lot of these days.
Exactly. That's a great question. And clients come to us all the time saying public markets have outperformed. Why should we still do private markets? And yes, one of the things we need to remember is that asset classes over time are cyclical and performance come in cycles. But over the long run, private equity has outperformed US large caps. So if we can pull up the data here for this cool chart that we put together, you can see that over market cycles, private equity has had a strong long-term track record. And I want to point out to the dark purple here, which is the private equity. Over the last 21 time periods shown here, private equity has outperformed and has been in the top 1 or 2 position in 11 out of the past 21 years. And in the long term, on the right-hand side, these are annualized returns over this time period horizon. You can see that PE has annualized a return of 14.3%. And you compare that to US large cap, which is right below that in that teal blue color there. US large cap equities has returned an annualized 10.7%, but with a much higher volatility. Now, beyond the headline returns here, including privates, also benefits diversification. And so if you include alternatives like private equity in a portfolio, it can improve returns and reduce volatility. So here we show a portfolio of 40% global equities, 30% US bonds, and 30% alternatives, which is in the dark yellow with the black box around it. That outperforms a traditional 60-40 portfolio, which is in the lighter yellow there. And that you can see that that happens in 16 out of the past 21 years here out of the quilt chart. And not only that, it reduces your volatility here. I can just share some numbers. The diversified portfolio with alternatives returned at 8.1% annualized with an 8.6 vol, and the traditional 60-40 returned a 6.6% return and a 10.4 vol. So much higher vol, lower return. But then also in summary, yes, public markets has outperformed recently, but including privates in the long run still adds benefication and diversification to your portfolio. Its ability to enhance risk return, adjusted returns we mentioned, but also the really key driver here, and Leslie has also mentioned that, is maintain diversification. Manager selection is very important, and having a portfolio allocation that aligns with your liquidity needs.
Right. So despite some of these near-term challenges, sort of the long, growth drivers still remain intact, which is evidenced by that quilt chart that you showed. Yes. Great. Thank you, Jennifer. Shaista, welcome, by the way, to the studio, and it's nice to have you here. I want to, because the infrastructure has certainly been a very interesting story for quite a long time in the public and now the private space. We're going from roads and utilities now to data centers and things like that. So talk about the story of infrastructure within the alts and the private space, because it's really compelling. There's a lot to unpack there and a lot to talk about.
Yeah, so I think, obviously investor interest within infrastructure has really shown throughout 2025. You see the data here, over $300 billion raised in 2025, and in the fourth quarter alone, nearly $107 billion of investor demand. Now, keep in mind, these are just drawdown infrastructure funds, so this isn't even including the inflows into our perpetual infrastructure vehicles as well, which is additional capital being brought in. So I like to think about this as twofold. So on one hand, you have the characteristics of infrastructure, which I think investors have really gravitated towards, right? In this market environment, in this higher inflationary market environment, infrastructure is an inflation hedge. Most sectors actually outperform in periods of higher inflation. Secondly, it's a really nice diversifier, low correlation across both public and private markets. And finally, it's pretty stable returns. Infrastructure in general will never be your highest returning asset class, nor should it be. But typically, historically, we've seen about anywhere from 8 to 11% of returns. So you have the characteristics, but then I think you also have these three themes we've been seeing, which we call the 3Ds of infrastructure. So digitalization, as you mentioned, right? The growth of AI, the build out of data centers, deglobalization, kind of the onshoring of manufacturing and other assets, and then finally decarbonization, right? Renewable power, in the US there's been some headwinds, but within Europe, most of the deal activity was concentrated there. So I think when you have these three themes combined plus these characteristics, I think that's why you've seen such an interest within this asset class. And as Jennifer and Leslie have both mentioned, I think ultimately manager selection is key when investing in infrastructure.
Right, and there's been a lot of capital raised, particularly in the infrastructure space.
Yes.
I think probably attributed to the digitalization you were just talking about.
Yep.
So it's a really exciting space to be focused on right now. Privates in general, but especially on the infrastructure side, since there's so much of a shift now to the digitalization side.
Exactly.
Great, Shaista, thank you very much. There's always a lot to unpack when we get all of us together. So Leslie, first of all, thanks for being here with us. And I want to also encourage our viewers to make sure you're checking out our Insights website at ubs.com/views. You can find the latest private markets quarterly publication there. And clearly there's a lot more detail in there. And we would encourage you then to follow up a conversation with your financial financial advisor to learn more about how it could fit into your portfolio. So make sure to take a look at that publication. And also follow UBS on social media. We're on LinkedIn and Facebook, plus the studio has its own Instagram channel at UBS Trending. Please give us a follow there. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon, everybody. Thank you.